Hello and welcome. My name is Simon French and I'm Chief Economist at Panmure Gordon. Today we're going to take a look at the prospects for the US economy in 2020, given what we've heard from the President of the United States, both at the World Economic Forum in Davos and in the recent State of the Union address. Now, clearly the President has laid out a picture of rude economic health in the US economy, and to some extent, and certainly comparable to other major developed economies, we expect the US to grow at the fastest amongst the G7 countries, G7, the largest economies in the world, during 2020. But whether it'll hit the President's ambition for 3% growth year on year, we're more sceptical. There has been, and there continues to be, headwinds to trade growth between the US and its trading partners, particularly China. And that disruption to the trading system, although there has been a phase one trade deal, should weigh on manufacturing output and consumer spending during the course of 2020, meaning that perhaps elusive 3% annualized GDP growth is going to be difficult to hit. By contrast, the consumer remains strong in the US economy, and continuing jobs growth, the kind of level of jobs growth that the Federal Reserve is uncertain how long it can continue for, continues to be a tailwind for spending power of US consumers and for the US services sector. And that really is the story, allied to potential pickup in both business investment and cyclical advertising spending. In what is a re-election year, there will be a macro significant impact from the start of the Democratic primary race, and then when the presidential race kicks off in earnest, when the incumbent president goes head-to-head with the Democratic candidate. A lot of that spending that only comes around every 4 years will be a tailwind throughout the course of the middle of the year in the United States economy. Looking a bit further forward, of course, a lot of the rest of the growth outlook will hinge on what the Federal Reserve signals to markets. And in their most recent they've certainly been quite sanguine about the rate path. They see interest rates on hold for the rest of the year, and that will continue to be supportive in terms of credit markets, for corporates, for households looking to take on debt during the course of the year. And the reason, of course, that this is possible is the ongoing very low inflation environment, and the Federal Reserve FOMC members being very, very uncertain as to whether the economy's inflation rate will return to that 2% that they have as a target. So summing up, benign inflation, meaning a very, very flat rate path, some uncertainty in the global environment with trade and coronavirus risks to the fore, but an underlying strong consumer means that US growth should be strong by developed market standards this year, but not quite hitting the President's target of 3%.